Hello, chart watchers, and welcome to this Tuesday, January 22nd, 2019 Market Watchers live show with your host, Tom Bowley. I'm going solo today, but Aaron Swinland will be back with me tomorrow. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. All right, let's take a look at what's going on in the market to start the week. It's not good news. We've seen a lot of movement to the upside off of that December 24th bottom, but not today. The Dow Jones Industrial Average currently down 309 points. The S&P 500 down about 35 2/3. The NASDAQ down 110 points. The Russell 2000 down 21. The 10-year Treasury yield looked pretty good on Friday. We got up to almost 2.80%. But we have fallen back now. We're back down below 2.75%. Of course, as money rotates into treasuries, that sends the yield lower. So unfortunately, money is rotating more into safety today, and that's normally not a good thing for U.S. stocks, and that is the case today. The volatility index currently up 1.72, which is up about 10% today off of the close that we saw in the 17s on Friday. To the downside, leading to the downside, you can see energy having a rough day today, down more than 2%. Also, industrials down at about 2% so far today. The durable household products getting hit very hard to the downside, primarily because of Stanley Black & Decker having such a rough morning because of their earnings. We'll talk about that in a bit. eBay, though, bucking the trend. eBay up about 6.75%. Elliott Management disclosed about a 4% stake in eBay and sent a letter to the board outlining a lot of opportunities for the company going forward, and traders cheering that news. Arconic, though, having a very rough day today, down about 16.5%. And as I mentioned earlier, Stanley Black & Decker down quite a bit here, down at $18 or so today, which, as I said, really a drag on the durable household products area of the market. Okay, well, I don't have Erin with me today. She will be back tomorrow, and there are some changes that we'll talk about in the schedule in just a little bit. But I do just want to say that, talked about over the past few weeks, some key areas in the market that we need to be concerned with, namely those 20-week EMAs, and we went right up and tested those on Friday, and we're starting to see some of this weakness hit the markets today. I think the way the market handles this pullback is going to dictate quite a bit as far as what we can expect in the days and weeks ahead and into 2019. I've mentioned before, I believe we are in a secular bull market, which means that I would not be surprised if the weakness that we saw in the fourth quarter is very short-lived. It was short-lived. We had a nice rally heading into 2019. But I'm not sure at this point that it is done. And we'll talk about some of the charts that we need to be watching as we move forward. But at least in the near term, getting that bounce was very nice, very normal, by the way, off of extremely high volatility readings that we saw. But we'll get into all that in a minute. We do have, want to go ahead and go through the upcoming schedule, and what we're going to talk about today. And then we'll kind of move into some of the key areas of the market, what we should be looking for. All right, upcoming schedule. We are going to start out tomorrow with Jeffrey Salt. He is the chief investment strategist of Raymond James, and if you may have seen him on CNBC. He's been on our show before. I know he has been extremely bullish in the past, so we'll see whether or not the huge fourth quarter sell-off did anything to change that view. But he'll be in tomorrow. So I'm looking forward to that interview. Arthur Hill, one of our very own here at StockCharts. I know a lot of you follow Arthur's work and his blogs and so forth. He will be co-hosting with Aaron on Thursday. I will be out Thursday, Friday, and Monday. So Arthur will be in on Thursday with Aaron. So you got a real treat there. And, of course, on Friday, Mary Ellen McGonigal will be back with her What's Hot, What's Not. So she will team up with Aaron on Friday. And then Greg Schnell will be in on Monday to sub for me. So you've got Greg and Aaron on Monday. So you got a pretty solid group of hosts over the next few days. And you'll be able to get different views, which I think is really important with what's going on in the market. I'll actually talk about Arthur's article that he had over the weekend later in the show. I found that to be very interesting and and very educational. As far as today, again, I'm solo on my own, so you got to listen to me all day. But hopefully we'll have some fun doing it. Monday setups. I know it's Tuesday, but market was closed on Monday, so I'll give you some picks for this week. Talk about what we had brought up last week as setups. I can tell you, sneak preview, not very good. But of course, when the market keeps going up and you're shorting, probably not going to work out well. The January effect. I'm going to explain a little bit about what that is and how I view it. There is a poll running right now about the January effect, and again, there are different views on what the January effect represents. Some people look at it as the first couple of days of the month. Some people just look at it as the fact that January is a solid month, and others, like myself, look at the January performance and use it as a barometer for the balance of the year. And that was the poll question today. Do you believe that the January performance has any bearing on how the market performs the rest of the year? So really appreciate it if you fill that out. Just a simple yes or no, whether you agree or don't. And we'll talk about that later in the show. We'll get into the 10 in 10. We're going to start off with Skechers in that really hot footwear group, or at least on a relative basis, the group has been hot. But we'll take a look at Skechers, which has not been quite so hot. And we're going to wrap up today. I'll go through some blog highlights, as I mentioned, talk about Arthur's blog, talk a little bit about Chart Watchers, which came out over the weekend, and hopefully give you some things to think about as we head into this brand new trading week. All right, let's get into today's action. We had one economic report out earlier today, and that was existing home sales. And the numbers came in a little disappointing. You can see on your screen there, the December existing home sales, 4,990,000 units. And the market was expecting 5,225,000 units. So unfortunately, a little bit weak there. I think I looked at the revision, and I believe the revision was still pretty much intact. I don't think that was lowered at all. So it was really a December issue with that miss. So let's take a look at the 10-year Treasury yield. I mentioned at the top of the show, 10-year Treasury yield pulling back. You can see here on this chart, we are back down, trying to hold on to that 20-day moving average. That was one of the key areas I wanted to see the 10-year Treasury yield get through to the upside. And for those of you maybe who are new to the program, the 10-year Treasury yield, there's a pretty tight positive correlation in the short term between the direction of the 10-year Treasury yield and the direction of the S&P 500. And the reason being, whenever the yield's going up, it means Treasury prices are going down. So as Treasury prices drop, you have proceeds from those sales that tend to move into the stock market. So the yield and the S&P tend to go up move in the same direction, because the 10-year Treasury yield and the Treasury prices move inversely or in opposite directions. So anyhow, when you see in the short term the 10-year Treasury yield moving down like this, it's generally not a good sign for the stock market. And if you look at what happened back in November and December, you can see the tumbling yield. And we know what happened with the stock market, the huge drop that we saw in November, especially in December in stocks. A lot of that, part of the problem anyway, was the fact that the 10-year Treasury yield was dropping so fast. Because again, why would money rotate into Treasuries? If you just think about that question, Treasuries tend to be great during economic downturns, not economic improvement. When there's economic improvement, we're seeing strengthening ahead, or our markets are expecting economic strengthening, money will rotate away from Treasuries and move into stocks, because stocks do much better during periods of economic improvement. So anytime I see the bond market reacting like this, and I see money rotating in a very big fashion toward Treasuries, that makes me nervous about what we might expect in terms of our economy going forward. Now, there were obviously some issues out there. We've got the whole China-U.S. trade tension, the war going on, trying to figure out, when that's going to resolve, in what way it's going to resolve, how beneficial will it be to the U.S. A lot of different questions coming out of that. We've got the partial government shutdown that's now been going on for about a month. So the market's trying to deal with all these things, and at the same time, we're getting a lot of movement, a lot of volatility back and forth in both Treasury and equity markets. So today, though, we are moving lower, and we really haven't seen much movement to the downside in 2019 in the 10-year Treasury yield. And so far, today, equity market's not handling it very well. So here's a pullback. Now I want you to notice, and I'm going to shorten this chart so you can get a really good view here. We'll just take a look at the last 3 months so you can really get a look at these candles. If you take a look back, January 9th through, I don't know, 9th through the 11th, maybe the 14th, you see this period right here where the 10-year Treasury yield went down or went a little bit sideways. Now let's look at the S&P 500 during that same period. And that same period, see how the S&P kind of paused? Part of the reason was money was rotating back into Treasuries. So that money's not available to go in the S&P. And then as soon as we made that bigger move back to the upside here in the 10-year Treasury yield, we go back to the S&P and you can see it coincides with a big move up in the S&P 500. Now today, part of the problem though is we're getting this move down in the S&P because, at least in part, because the 10-year Treasury yield is dropping. So if this 10-year Treasury yield keeps moving to the downside, we want to be really careful. Anyhow, there's a long-winded explanation, but hopefully you kind of get the gist there. All right, let's move into the earnings because there were a number of earnings reports out. Let's take a look at those. We had Johnson & Johnson coming in a little bit better than expected. Prologis, the Travelers came in weaker than expected. You can see that bottom line missed $2.13 versus $2.20. Stanley, Black & Decker, flat, but I'm pretty sure that they had lowered their guidance going forward, and I've got that number here. Yeah, they guided their fiscal year 19 earnings per share lower. So you look at this and you say, well, their earnings matched. Why is the stock getting hit so hard? Well, the big reason because they're guiding lower. Market likes to look ahead. So all of a sudden, growth projections, growth rates go down when companies warn. So let's take a look at that particular stock here in just a minute. I'm going to start with Johnson & Johnson. So let me pull up Johnson & Johnson first. All right, I've got this on a relative chart. So again, for those of you maybe who are new, here's the price of Johnson & Johnson at the top. Then I've got their industry group, which is the pharmas here. Below that, Johnson & Johnson relative to the pharmas. So how is the stock doing relative to its peers? Then finally, we've got the Johnson & Johnson relative to the benchmark S&P, and then pharmas relative to the S&P. So you can see how their group is doing. And you can see over the past 5-6 weeks, the group has been struggling versus the S&P. So while the overall market went down in December, this went down a little bit faster. But the big thing is that during the rally in 2019 that we've seen in the market, pharmas have taken a back seat. But I suspect if the market rolls back over, we're going to start to see this relative strength pick back up again. Anyhow, Johnson & Johnson, you can see, I think this was the news that came out. What was that news? It was in the baby powder. Anyway, can't remember it. But anyway, it was startling about the asbestos. Thank you, Zach. Yeah, the asbestos claims that there was asbestos in baby powder, and the stock went from 147 and change in about 2 weeks down to 120. For a company this size, that is a major move. You can see it took Johnson & Johnson months to move from 120 up to 147, and in 2 weeks went from 147 back close to 120. So unfortunately, market's not very kind in that regard. We do see sometimes these sell-offs occur very quickly. Anyway, Johnson & Johnson did rally, got back up to the 20-day, came out with their earnings today. They beat on the top line, beat on the bottom line, but they guided their fiscal year 19 revenues lower. So the stock gaps down today. Now, maybe it's all built in, but I would be careful. When I get a stock that's doing this, falling well below the 20, comes up, tests the 20, a lot of times I'm looking for it to roll back over again. So based on everything I'm seeing on this chart, you can see Johnson & Johnson relative to its peers in pharmas, not very strong. So it's hard for me to argue a bullish case right now for Johnson & Johnson. If I was looking at pharmas, I'd be looking elsewhere. I'd be looking at different stocks within this group. All right, let's take a look at PLD. Again, these are all companies that reported earnings. Prologis, you can see big move back up. A lot of volatility today with the earnings. Kind of looks like trying to figure out, make up its mind which way it wants to go. It wasn't far from its early December high at today's intraday high, but it has backed off of that level. Travelers, mentioned the miss on the bottom line. They did beat on the top line. The stock, though, has been in this downtrend, had already rallied into the earnings report. I would just be paying attention to that rising 20-day EMA. As long as that holds to the downside, I think we're okay here. But if we were to break down below the 20, I think it's probably going to bring that recent low in December down around 111, 112 into play. Halliburton reported beat on the top line, beat on the bottom line, but the stock, after bouncing over the past few weeks, pulling back with its earnings down about 5.5%. So far, holding on to the rising 20-day moving average. And again, that's what I would keep an eye on. All right, the one that I talked about earlier, Stanley Black & Decker. Big move down today, down 13%, really hurting the durable household products companies. And they did beat on the top line, $3.63 billion versus $3.62 billion. They matched the bottom line at $2.11, as I mentioned, and then they guided their fiscal year 19 earnings per share lower. Now, some of it, you might argue, was already built in. The stock was at 155 in September, and by the end of October was down to 105. So it lost roughly 1/3 of its market cap in, 5 weeks, 6 weeks? So we've been consolidating sideways. I suspect we'll probably go back down, especially if the market weakens. I would suspect we'll go back down maybe in challenges 105, 110 area of support. But again, it's hard to like a stock that just lowered their earnings per share in the upcoming year. I think it's going to take a little while for this one to settle back down. Look at the volume today, too. Almost 5 million shares already, and we're not even to the halfway point of the trading day, and it already is more than anything we've seen over the past year. So clearly, Stanley Black & Decker under some pretty serious high volume selling today. All right, how about First Third, FITB, First Third Bank? Stock getting a pretty nice reaction so far. They did come out and beat on the bottom line. I didn't see their top line, but the market likes it nonetheless. Now, on the way down, notice we did struggle at about $28 on several occasions. I'm going to say maybe 27 to 28. We broke down, came back up, had a double top at 28, and here we are in the middle of this 27, 28 range. So even though we've had this huge move up and things certainly have improved, FITB still got some overhead resistance coming and a little bit more work to do. All right, let's take a look at a couple of major indices, and then we'll get into upgrades and downgrades. I just wanted to bring up the S&P 500 and maybe the NASDAQ. You can see today really having a rough day today, down 1.26%, but I'm most concerned about the weekly. The daily looks actually pretty good. It's been holding the rising 20-day, but this is where I think the market has got its biggest problems. The weekly charts. We closed almost right on the 20-week moving average on Friday. So we came back up on the S&P, cleared a couple of key overhead resistance areas in terms of intraday price resistance, closing price resistance, but then that 20-week hit, and now we're seeing some weakness. I'm not surprised. The question is, how far are we going to go down before we can go back up and set a new high? If the bulls could somehow pull the rabbit out of their hat today and reverse this thing and go back up and close higher, it's going to become much more difficult to make bearish cases going forward, in my view. But if we fail at this 20-week, as I would expect, and we start to see volatility come back in like we are today, then I think the bulls are going to have a serious test over the course of the next few weeks. So we'll see which one, just kind of continue to watch the price action. That'll help tell us what we need to expect going forward. But that was the S&P 500. If I pull up the NASDAQ, you can see the same thing. There's your 20-week test, down about 1.5% today. Let's see how we finish. The other thing is during this rally that we have seen over the past few weeks, if we go back and look at, say, a 1-hour monthly chart, you're going to see for the most part that the market has been closing strong in the afternoon. The one exception was the day Apple warned back on January 3rd. But otherwise, we've had some gap downs, but the market keeps rallying back, showing a lot of resiliency. Well, if you notice, we started to see a little weakness in the afternoon on Friday, and that's continuing today. So we'll see how we finish today. But weak finishes are common more in downtrends, where strong finishes are more common in uptrends. So let's see how we close today. All right, upgrades and downgrades. Had a few of them here. So let me go through these pretty quick. First is on the upgrade side, FISV. So this is Fiserv, and there were a lot of upgrades and downgrades. I'm just going over a couple of the stocks. Fiserv had gapped down earlier last week. I believe they came out, they made an announcement they were acquiring another company, and I forget. But anyway, the stock did gap down as the acquirer, not unusual. Went down, tested support, but it's been rallying since back to the upside. And this, I think they may have acquired FRC. But anyway, here is the move back to the upside, big move. Currently, the stock is down with today's upgrade, but after the move from 68 and change up to 78 in 3 days, I'm not surprised. Also, you've got a little bit of overhead resistance here at 78. I think a pullback back down to around the 75 level would be fine. I think the stock technically still looks okay with this pullback today. Next up is Palo Alto Networks, PANW. They had a couple of upgrades today, but I don't like the candle. I mean, this is a reversing candle off the uptrend if it holds into today's close. If that's a big reversing bearish engulfing candle, I would be out of the stock off of this uptrend. I think it could lead to a 20-day test, which would be down about another 5% or so from current price. Let's see, downgrades, Fortinet, FTNT. Stock continuing to roll over. Check out the PPO rolling over at the center line. That's not good. We're in an overall downtrend. We have still not been able to clear the lower highs. So we got this series of lower lows and lower highs that are still in play. Until we get up through about 77, 77 and a half, I would be concerned about this stock being in this downtrend. GPS, this is Gap, continues to be in a downtrend. Downgraded today. I don't really see anything at this point that would suggest it's ready to move higher. I would watch the support levels that have been, basically we have a double bottom from the mid-November and December 24th timeframes, down at about 24, 24 and a half, currently trading at 25, down about 3.7% on today's downgrade. And then Tiffany's, TIF. Tiffany's getting back to the 50-day moving average, but now starting to roll over. I'm a little concerned with this one. When I get a 50-day test and I get that center line test reset on the PPO, a lot of times that will lead to a resumption of that prior trend, which clearly is down. Volume trends are awful. I think Tiffany still has some work to do. And once again, if the market rolls over and starts moving lower, I doubt that this one swims against the current. We'll see. Anyhow, let's take a look at those upgrade, downgrade summary here. You can see there were several other upgrades and downgrades. There were more than that, actually. I just pulled out some of the big names to show you, but those were at least a pretty good summary of some of the upgrade and downgrade action that we saw today. All right, let's move into the Monday setups. And again, I know it's not Monday, it's Tuesday, but Aaron and I tend to come up with our setups every Monday. We've got a guest on tomorrow, so I don't think we're going to have a chance to do the setup. So I figured I'll go ahead and go through that today for you. So our setups from last week, and I will say Aaron's FRC came out with earnings, and I don't think she probably knew that at the time, beginning of last week, but the stock really soared on its earnings. So first, let's take a look at FRC and TX. First is FRC. Yeah, this is when, so starting to roll back over, and I think one of the things she liked, I don't want to put words in her mouth, but I believe she was looking at the PMO. Now, this is the PPO, but I think the PMO was rolling over and either getting that signal crossover was about to. Unfortunately, FRC did come out with earnings, and anytime you get earnings, you can, at least in my view, you can throw technicals right out the window. That's why I don't like to hold anything into earnings. FRC did come out with good results, and like I said, I think this might have been also part of the acquisition that I talked about earlier. I think it was First Republic that was acquired. But anyway, you can see the big gap up here and the continuing move to the upside. But again, I would not hold into earnings. My pick last week was TEX. It started off the week okay. It was actually, I think, 29.58 or something like that was the short. And it did go down below 29 initially, but then it came up the end of the week. And for the most part, if you're shorting and the market keeps going up, 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 it's going to be hard to make money. A rising tide's going to lift just about all boats. And I think that was the case here. For sure, we did break out above 30. I probably would have gotten stopped out with a loss had I been trading the stock. It is coming back down today. I'd like to see it get back down below the 20-day moving average. I think if stocks start to roll over and they lose that rising 20-day moving average, then I think it could bring those prior December lows into play. All right, so let's get into this week's setups. I'm going to go with another short, and I put this one in my blog this morning. Apollo Management, or Apollo Global Management. Stock is getting hit pretty good today, down about 4%. The thing that attracted me to this was simply the reward to risk was really strong. Things had turned around. APO broke. You can see the PPO breaking above center line. So that's telling you bullish momentum is picking up. But there was a lot of selling that took place from the beginning of October through the end of the year on a lot of volume. And I think this was another one of those cases where it was just a rising tide lifting all boats. The stock was moving higher, but it did hit what I thought was some pretty key overhead resistance. Went above 29 intraday on Friday, but failed. That's usually a warning sign to me. So I was taking a shot that maybe this one would pull back. Now, the current price, unfortunately, because it has pulled back, I'm going to go ahead and go with it anyway. 27.29 is the current price, so we'll go ahead and use that one. I was thinking in the blog that maybe we'd get a pullback here to the 20-day. If it can break through the 20-day to the downside, I think that would be much more bearish. Otherwise, I think I'd keep a stop on a close above 29, maybe 29.5. There was that couple of intraday moves that got above 29. So maybe give it a little bit of room. But if the overall market goes down, I suspect APO is going down with it. A couple of other stocks that I mentioned, or that I will mention. ACCO. Now, this stock is holding in pretty well today. But if you notice the huge gap down at the end of October, the reaction high was just at about $9. And then we went all the way down to $6. Another 1/3, even after the stock had been under a lot of selling pressure. From the early November high, it fell another 33% down to $6. It has made its way all the way back up. There is a lot of volume coming in, so you do want to be careful. But this is similar to APO. I think as it moves up, I can at least keep a tight stop. I think if you move much above $9 on an intraday basis, I'd be concerned. But this is an area where I would look for at least a pullback, maybe to test that rising 20-day. ERF, I mentioned this one because this is a stock actually that John Hopkins and I had talked about, and I know is one of the short alerts right now at earningsbeats.com. But the stock had come back up. You can see the gap down. Look at the heavy volume in early December. It gaps down and it goes down to $9. Notice the recovery gets back up into the 940s and then sells off again. Now, as we come back up, we get into the 940s, failed, couldn't break through, and now gapping back down today. And the volume has picked up. So let's see if this stock can hold its 20-day moving average. Failure to hold the 20-day, I think, would lead to a much bigger drop to the downside, potentially back down near that $7 level. IVC, Invacare. Looking at this rally, yeah, things looked pretty good, but it had the breakout above the 50 and it failed 2 days in a row. Then it put in a bearish engulfing candle. Now it's trying to rally a little bit. The volume trends here, very weak. This stock was at $13 early November, went all the way down to $3. I mean, it was deserving of at least somewhat of a rally. Stock got up to almost $6. I think probably put in a short-term top. I suspect that the overall downtrend, you're going to see sellers come back in, and another close below that 20-day moving average would not be good here. And then the last one I have is PPC, Pilgrim's Pride. Nice move to the upside. Like APO and some of the others, though, I think as it gets up closer to this $19.50, $20 area, that is where we have seen problems. That's where we have seen selling. A lot of selling came in early December from that 1980 area. Today's high was 1970, already backing off of that level. I wouldn't be surprised again maybe to see a 20-day test going forward. So let's go ahead and do a quick summary of the setups. Hey, there's one thing for sure. I can't lose to anybody in my pick this week. Since Aaron's not here and I don't have a co-host, I'm going to win. I just figured that one out. Okay, let's move on. All right, the next area that I wanted to talk about was the January effect. And as I mentioned earlier, and just a reminder, there is a poll running on the January effect. There are different theories, different explanations, definitions for what the January effect is. So I'll go over a couple of those with you. But the way I look at the January effect is, what is the market doing in January? And does that have a discernible impact on how the market trades the rest of the year? Interesting question. And I'm going to be really interested to get everyone's thoughts on that after my presentation. We'll bring the poll up in just a little while. But I'm going to go into this presentation now and talk a little bit about the January effect. So let's take a look at, hopefully you've got this now. This is an Excel spreadsheet, essentially, of the January effect. Now, as I mentioned earlier, and this is not going to be charts, it's going to be numbers, so hopefully I don't bore you all too much with this, but I do think it's pretty interesting, and hopefully you'll agree with me. And you don't have to necessarily agree that January is a great predictor of the balance of the year, but I think after at least going through these numbers, you'll have something to think about. So there are a couple of different ways to think about the January effect. I saw an article about a week ago, maybe 2 weeks ago, from Mark Hulbert from Hulbert Financial Digest. And he talked about the first 5 days of January and how many market pundits in the past have suggested that the first 5 days of January can give us a clue about the year. And he went on throughout that article discussing why he thought it was a bunch of hogwash. And that was the idea for me to come up with the January effect. I mean, I'd already done the study in the past, and I am a believer in it. And I'll go through some things and show you. I might sway you, I might not, and that's fine. Either way, everybody's entitled to their own opinion. But when I read Mark Hulbert's article, I thought a lot of what he is saying is really misleading. And I'm a fan of Mark Hulbert's. I'm a fan of the Hulbert Financial Digest. But I thought that the article was misleading. I didn't think that he did enough research to come up with the conclusion that he came up with, which was basically that the first 5 days of January there's no statistical relevance. I think there's statistical relevance in what I'm about to show you. The other January effect I've seen referenced is just the fact that January is a good month. Not that it necessarily portends anything in the future, just that the January effect is the fact that the stock market tends to do well in January. Well, that's true in some circles. The NASDAQ, it's been the best over the last 20 years. It's been the best month of the year for the NASDAQ. S&P, not so much. So I think it depends on what you're looking at and your data. I am going to concentrate on the January effect being an indicator that suggests, and maybe you've heard the Wall Street adage, as goes January, so goes the year. To me, that is the January effect, and that's what I'm going to talk about today. As goes January, so goes the year. Now, on this spreadsheet, what I have done is, and I'll go over the columns here. I'll talk about the sorting in just a minute. But for every year since 1950, I have the full year performance for the S&P 500. So, for instance, in 1987, the S&P 500 rose 2.03%. In 1975, the S&P rose 31.55%, and so on. In the next column is the January performance. So in January 1987, the S&P 500 rose 13.18%. January 1975, 12.28%, and so on. The final column is February to December performance. And one thing I want to note is that this performance is the percentage is based on the January 31st close, not the December 31st close. Because as a CPA, and maybe I have some fellow CPAs or nerds like me that follow would look at a spreadsheet and immediately say, well, why don't these two numbers, when you combine them, equal the number in this column? If you look at this one, 12.28, 17.16, for instance, if you add those two together, it's 29.44%. That doesn't equal 31.55%. Well, the reason is the full year is based on the return for the year divided by the S&P as of December 31st, 1974. The January number is divided into the S&P balance, or the S&P number as of December 31st, 1974. The February to December number, though, is divided by January 31st. So you don't have the same denominator. So you're not going to get the same, you can't add these percentages up. I just want to be clear about that. And it doesn't make sense for me to take a look at February through December performance, get the number, and then divide it by December of, December 31st, 1986, because that's not the return. The return isn't off of that number. It's the return off of January 31st. Anyway, probably boring you with all that, but I just wanted to make sure if you were looking at this and you happen to see that, hey, these numbers don't add up, that's why. Okay, so what I've done is I've gone back to 1950, and I have every year through 2018, the data, full year percentage, January percentage gains, and then the balance of the year off of the January 31st number. And I've sorted them into quadrants. And if you notice, January, this is the column they're being sorted on, January performance. So for instance, over the last 69 years, I have 18 years in the top quadrant, which is about 25%. The next best Januaries go into the second quadrant. These are the next 17 best years in terms of S&P 500 performance in January. Then we get into the third quadrant. You can see these numbers dwindling. And then we get into the fourth quadrant. Now, when I look at these numbers, a couple things really stand out to me. Once I sorted them, and you can see that the average, in order to get into the top quadrant, January, you would have to, the average is 6.75%. You would have to get higher, you'd have to move in January more than 4.1% to the upside, and you'd have to close there January 31st to get into this top quadrant of Januaries. Now, when you look at this list, at least, if I had not seen the spreadsheet and I had not done the research, and I was just thinking about it from a common sense standpoint, and I didn't hear anything, I didn't know anything about as January goes, so goes the year, I would have thought probably that in years where January is really strong, that maybe the balance of the year wouldn't be as strong, because I know that the average return for all S&P 500 years since 1950 is about 9%. So if a year has, January rising by 6, 7, 10, 12%, then it would just make sense that the rest of the year probably isn't going to be that good. Well, that's not the case. And in fact, when you look at these numbers, here is your January return. Look at column D. This is the balance of the year return. So the average return for this top quadrant is 6.75% for January. The average for the balance of the year for all of these years is another 15% on top of January's. So the average return for the years that have the strong Januaries is 22.6%. That's quite a bit above that 9% level. And you can see even after strong Januaries, another 15% on top of it. I think that's pretty strong. And so when I was looking at this, I started highlighting. And I said, okay, quadrant one, this is the top 18 years of January performance. Again, based on that column C. So 1987 was the best. 1999 was the worst in the top 18. 16 of these 18 years saw gains over the balance of the year. So only twice, and just so happens 1987 was one of those years. The best January was followed by a not so great balance of the year. That was the crash in October of 1987. That was the year. To me, that's an outlier, but treat it how you may. Definitely, it was not a good year, but it's and that does feed into these averages, though. By the way, so but anyway, that was one of the 2 years that it didn't work. The other one was last year, 2018, and that was one of the things Mark Halbert was pointing out in his article, is that if you followed this in 2018. You'd have been really disappointed because January was strong and the balance of the year went down 11%. And I was just thinking, okay, that's a little misleading. When I put this together and I look at the top 25% of all January since 1950, that is one of the outliers along with 1987. Look at all the ones where we have gone up higher. 13 out of 18 years, 13 out of these 18 years, we saw double-digit gains over the balance of the year, in addition to what we saw in January. So it's not including January. We're starting over. January 31st, we're starting over. And in roughly 2 out of 3 years, a little bit better than 2 out of 3 years, we went on to post double-digit gains for the balance of the year. And 5 of the 18 years, more than 25% of them, saw 20% gains or more after a strong January. Now let's move on to the second quadrant. All right, so the second quadrant, you see January performance go from 4.05% down to 1.73%. So still a good month. I mean, a nice month, but not the top months. So this is the second best quadrant of January's since 1950. Let's take a look at some of these highlights. 14 of the 17 years. Now, remember up here was 16 out of 18. So now 14 of the 17 years saw gains over the balance of the year. Still pretty good, but a little bit less percentage than we saw in quadrant 1. 9 of 17 saw double-digit gains over the balance of the year. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9. So that compares to 13 out of 18. So again, the percentage of having a really strong second, well, not second half, but a really strong February 1st to December 31st period, the percentage goes down. It's still not bad, but it goes down. And only 2 of the 17 years saw 20% plus gains over the balance of the year. So we saw that here in 1995 and in 1955. Well, that was the only 2 years where we had more than 20%. And so 2 out of 17 versus 5 out of 18. So you're starting to lose the likelihood of a really good year when you move into the quadrant, that second quadrant. All right. Let's move on to the third quadrant. And by the way, the averages, you can see first quadrant, 22.6% for the year. Second quadrant, you're down to 13.02%. You're still above that 9% threshold. And you can see average January performance, 6.75%, down to 2.83%. The average balance of the year return, 15.01% versus 9.94%. Now we go into the third quadrant. So now we're starting to move into some of the years that go down in January. About half of the third quadrant goes up and about half goes down. You can see the average for January drops now down to a minus 0.58%. And let's take a look at some of these highlights. 11 of 17 years saw gains over the balance of the year. So again, we're ignoring January performance. We're only looking at February through December. And if you've had a little bit more of a questionable January, the tendency is that you've got a better chance for a very questionable balance of the year. 11 of 17 years saw gains. Only 5 out of 17 years saw double-digit gains. So you can see not as many as I scroll down here. And only 2 of 17 years saw 25% or more. So 2003 coming out of the bear market and 1998. Those were the only 2 where we saw more than 20% gains after a not so great January. And you can look at the averages. Again, the averages for the year, 1.21% versus 13.02% versus 22.62%. Looking at the average for January, obviously the Januaries are not as strong as what we saw in the other 2 quadrants. And of course, when we get into the balance of the year return, 1.79% on average versus almost 10% versus 15%. So as the January performance goes down, so does the balance of the year on average. Now, again, am I saying that this is a guarantee? Of course not. Look in here. I mean, there are definitely years. Here's a down 2.74% when we rallied 30% the rest of the year. So if you had just gone in and looked at this year and said, well, January's rough, it's going to be a bad year, let me just move to cash, you would not have been very happy hearing about the January effect that year. It didn't work. So we're talking in terms of probabilities, and that's really important. Probabilities, not guarantees. Finally, let's move into this last quadrant. And I find quadrant 3 and 4 actually to be somewhat similar. But here are the worst Januaries on record. And by the way, the worst January on record was 2009, and we rallied 35% the balance of the year. Just like at the top, the best January on record, and we really struggled. We actually had a cyclical bear market in 1987 with the crash. So kind of ironic that this looks like a pretty good system, but the best January did not result in strength the balance of the year, and the worst January did not result in weakness. So something to consider. Anyhow, if you start looking at the numbers, though, I think you're going to get a sense that bad Januaries generally are not good for the stock market. 11 of 17 years in this quadrant saw gains over the balance of the year. 5 of 17 saw double-digit gains. Only one, that very last one down there, only one saw a gain of 20% or more after being in this bottom quadrant. So you can take a look through here and you can see that the returns for the year are lower. The January average a whole lot lower. Balance of the year, though, in that bottom quadrant, still pretty weak, but actually a little bit better than quadrant 3, but way below what we saw in these other areas. So when I look at this, I don't think there's any doubt in my mind that the tendency for the stock market is to follow January's lead. Again, the tendency, the probability, not the guarantee. So how we do over the next couple of weeks, or actually next 9 days, a little more than 1 week, will potentially have somewhat of a bearing on the balance of the year based on this, in my opinion, because if we happen to rally strongly into the last week of January, and we are able to get up into this top quadrant, I think that the results going forward are, the odds of having a really strong balance of the year are much better when you have a strong January than when you have a weaker January. And I think all of these numbers bear that out. So why don't we go ahead and pull up that poll? I'm interested now in seeing, I wonder if I swayed anyone. But my guess is, and my guess was before I even thought about this poll, or when I first thought about this poll, I figured that the overwhelming majority would say that there's no correlation, or that they don't believe in the as January goes, so goes the year. But we'll take a look, and yeah, there's the poll. You can see 78% out of 187 say no, 22% agree with me and say yes. Well, 23%. Maybe I'm swaying some people now. It's a hard one because, again, the first time you bring something like this up, it probably isn't going to work. That's just the way statistics and history work. And we've seen, as I pointed out, 1987, the best January on record. You'd think we'd be flying the rest of the year based on this theory, and yet we fell. The worst January on record, you think, okay, that's going to lead to a horrible performance, and yet that was back when we had the end of the bear market in 2009, and of course that initial rally coming out was powerful, and so the balance of the year was up 35%. So it just depends on timing when you talk about it. But I do think that there is a tendency for the market to follow through with what it sees in January as we enter into the balance of the year. So it's just one thing. Again, this isn't something that I would put all of my eggs in. I wouldn't say, wow, January did this, so I'm going to be all in the market in 2019. I think that's a mistake, that line of thinking. But if technicals begin to line up really well, and you believe my theory of a secular bull market, where we just went through a cyclical bear market, typically when you come out of a cyclical bear market, you explode to the upside. So I could argue that if we do finish strong in January, that it is likely to portend for much higher prices in 2019. So anyhow, I think it's interesting. Of course, I'm a CPA. I'm a nerd. I like these kinds of things. I like analysis. I like to try and figure out what makes the market tick. And I think that the January effect does have something worthwhile that you should at least be paying attention to. And there is the summary. Some of the things I think you need to at least consider. January performance provides us a probability for balance of year performance, not a guarantee. The January performance quadrant matters based on history. So it's not so much, if you get to 7% in January, you're going to do 10% balance of the year. It's just you want to be in that top quadrant. You have a much higher likelihood of continuing that move to the upside. And then finally, the stronger the January, the better odds that we'll see a strong year. Okay, let's keep on moving now. I know we got the 10 in 10. We're going to start off with the first one, which is SKX Skechers. So let me get that up on our screen for us first. Okay, you should have it up on your screen. Skechers not having a very good day. Actually, I'm going to come back to this. I want to show you seasonality on Skechers. I'll show you a couple things here, actually. Something I think you might find interesting. All right. So this is just the last 5 years history, but let's go back 20 years on Skechers. Look at the performance in the first 4 months of the year. Average January return 5.9%, February 7.3%, March 4.7%, April 13.7%. If you just add those numbers up along there, you would come up with about 31%. That's the average return on Skechers, January through April over the last 20 years. And we're in January. So seasonality, Skechers is right up there with like Booking Holdings, formerly Priceline. But Booking, BKN8 or BKNG. These are two of the best seasonal performers in the first 4 or 5 months of the year. Something to consider if the stock starts to look better technically, because I'm not quite there yet on Skechers, but it's getting closer. I think it's starting to look better, and we'll talk about that in a minute. The other thing, if I pull up Nike. If you look at Nike, which is also obviously in the footwear space, January and February are weak on average. March is good. April's okay. But look at the end of the year, September 5%, October, November, and December. So what I was finding is that if you're going to be in footwear stocks, you want to be in Skechers the first 4 months of the year and maybe Nike the rest of the year, or maybe nothing in the summer and Nike in the last 4 months of the year. Another way to look at this is I'm going to pull up a relative chart for you. So this is Skechers versus Nike. And I'm going to put it on a line chart. And I'm going to go back 10 years. We're going to make it weekly. And so how does Skechers perform versus Nike based on what we were just looking at? Well, if you look at 2010, huge rally. Skechers versus Nike, and then decline second half. 2011 ended up going down sideways for about 3 or 4 months, then down, and then continued moving down the second half of the year. First half 2012 up, second half down. First half 2013 up, second half down. 2014 up, and then back down. 2015 up, back down. 2016 up, back down. 2017 flat, and then up, and then 2018 mostly down throughout the year. My point is, when you look at this, it kind of follows exactly what that seasonal chart was telling us. First part of the year, Skechers tends to be the stock that you want to be with in the footwear space. Second half of the year, it's more Nike. I don't know if you all have, or someone out there has a reason for it. I prefer following seasonal trends that I can explain. For instance, I think Booking Holdings does so well in the first 4 months of the year because I think travel really picks up in spring and summer. And so I think the market looks ahead, and I think that's why the stock does well. In this case, I don't know. I'm not sure. Nike in September could be back to school. I don't know why Skechers is better in the first 4 months of the year. But anyway, just wanted to point that out. So let's go back now and let's take a look at the chart, get into the 10 and 10. So here's a problem I have with Skechers right now. Footwear, if we go down here, you'll see footwear is breaking out on a relative basis to the or versus the S&P 500. So versus the benchmark, it's doing great. But if you look at Skechers versus the S&P 500, it's horrible. And if you look at it relative to its peers in footwear, it's horrible. And another way to look at it is, here's the footwear index. See the double top here, equal? Right here, Skechers is going down. Footwear is actually breaking out now. And yet we could not even get up to the prior highs on Skechers, and it's pulling back today. So I like the fact it's above the 20-day, and I do like the fact that seasonally it does start to perform better in January, and you can see we are beginning to do better. But can we hold the 20-day? I mean, maybe as a flyer, you could take a shot at the 20-day, and if it doesn't hold, get out and then wait until it gets back above that 20-day again. But knowing the seasonal pattern of Skechers, this one's always on my radar as I head into a new year. And if the stock begins to show some outperformance, and you might say, well, how about that big, heavy volume move to the upside? Well, it's good, except it hasn't cleared resistance. So I'd like to see a little bit more technical proof of Skechers, or maybe a pullback below the 20 intraday and a recovery, so that we have a nice bullish test of a rising 20-day. That would be something maybe to get me interested. But right now, stock's down 4.4% today. I think it's just a little bit too early. I think it's clear on this chart, though, that Skechers is one that you want to be, I don't know, maybe it's looking a little sketchy. No pun intended. All right, Starbucks. I love Starbucks for so many reasons. My blog that I write every morning, Trading Places, I write it from Starbucks every day. That's pretty sad on the one hand, but that's where I kind of get my, I don't know, the writing juices flowing for my blog articles. Anyhow, Starbucks doing well today. They did announce, I saw this morning, that they were going to start delivery of their coffee. So I guess it's not enough that you have mobile, where people just walk in and grab their drinks pre-made and walk back out. But now they're actually going to begin delivery. I don't know how popular that's going to be. They did test it. I think they tested it in 200 stores around the Miami area some point this past year. And now they're going to be unrolling it in, I want to say, San Francisco, New York, Washington, maybe Chicago, some other areas, some of the big cities, markets, test it and see. But they're going to charge, I think, $2.49, which I don't know. To me, it seems like it won't work, but maybe it will. I mean, Starbucks has a way of making things work. Anyhow, taking a look at the stock technically, I like it. I think, first of all, it's in the strong restaurants group. When you go back and you look at the restaurants versus the S&P 500, you got clear leadership that started in the fourth quarter. Now, the overall group didn't necessarily go flying higher. You can see actually in December, the group came down quite a bit, but it's not far from breaking out on an absolute basis. And in a market that's been this weak, I think that's pretty impressive. When you look at Starbucks, about the time they came out with their earnings back in November, they began outperforming their peers. So I think you've got a good, strong stock in a strong space, and it is moving back up again, breaking out above this high. I like Starbucks. I think it goes higher. I think first test is going to be 68, 68 and a half, but I do expect we're going to see higher prices in time. CRON. And Starbucks, by the way, was the most requested or the favorite pick in the chat room. Kronos, CRON, making a breakout. I mentioned this one last week. I think it's one of the strongest looking stocks in the cannabis space. I thought the triple top breakout last Friday was very bullish. It's continuing that move today. I like the stock. I think it goes higher. Now, it is very volatile, so it might be 15 and change today and 13 and a half tomorrow. You have to understand the volatility there. I prefer looking at it on a 20-day test on a pullback, but this is one I expect will go higher in time. Oh, and I didn't even annotate. Let me go back. I meant to annotate these charts. So let me pull up the Starbucks. And let's annotate this one. Yeah, I think first of all, on Starbucks, that gap support, we went down, we went below the top of gap support. In a good market, I think we would have held. I think this was a case of baby going out with the bathwater. Market was just selling off. Everything was selling off. Everyone was panicking. And that led to one day going below the top of gap support and then right back up. You can see we've been holding it on prior or on more subsequent pullbacks. I think Starbucks is going to go higher and test that recent high just above $68. So let's go ahead and save that. These are so easy to use, these tools at Stock Charts. All right, so if you're following Stock Charts and that was one you wanted to save, there it is. Now it's in my chart list. It's in my folder. You do have to be a member, though, to be able to save and annotate charts like this. Okay, next up was Kronos. So let me pull that up again. Again, that breakout was really strong. You got a nice uptrend in play. Let me draw that uptrend line in here. So that's certainly an area that you could watch. As I mentioned, the rising 20-day moving average is something that I definitely would keep an eye on. And that right now is almost at $13. And then the breakout that I talked about, the triple top breakout on Friday, there you go. Moved up. That the 1375 area really struggled to get through on a closing basis. We did it on Friday, and you can see the volume pick up. So that was really good action. I think the stock is going to go higher in 2019. All right, so now I'm caught up. Now let's get into MJ. An alternative harvest ETF. Big downtrend. The breakdown in December was at a 52-week low. Don't really need this one, by the way, on the relative chart. I think, like the overall market, if you're going to treat this as a bullish move to the upside and you really think the market's going to go higher and you think that the selling is behind us, then we should be looking at these rising 20-day moving average holding as support. With the PPO above the center line and rising, it's telling us we got bullish momentum and it's accelerating to the upside. So to the downside, back down here at the 20-day, I would be looking for some support. So that's what I think it looks good right now. But again, if the market rolls back over and that VIX continues to rise, we could see more selling kick back in again. Going to be an interesting next week or so, I think, in the market. All right, next up is DBX. Another one breaking above the 20 and holding. The rate of gain to the upside, though, if I pulled up the rate of change, probably wouldn't be that impressive here of late. It did break the downtrend, but the volume has been weak on this move to the upside. I think DBX is going to struggle here. Today it was down. It has rallied back. If it could clear that reaction high and then this, I'm just looking at 23.5, 24.5 being some pretty serious overhead resistance. And we are in an overall downtrend. So again, if the market rolls over, I would suspect that this one will not be immune to that weakness, and I would look for the stock to roll back over. If you're on the long side, I would just continue to watch that 20-day moving average. All right, halfway home. Let's get into number 6, CTL. CenturyLink's already rolled over. I do not like this chart at all. We've got a downtrend in play that clearly is still intact. So if I were to draw my trend line here, I could just take these last couple of lows, or excuse me, last couple of highs, and you can see right there. That is a perfect trend line that continues to hold. And now this is kind of what I was expecting the overall market would do. I thought maybe when we broke down, we'd come back up and get through the 20-day moving average, but that we would struggle when we got to some overhead trend line resistance, price resistance, 20-week EMA, that sort of thing. And CTL has done that. You can see as it moved back up, got through the 20-day on some pretty good volume, but quickly retreated, couldn't get through the trend line resistance, and now looks to me like we are heading back down to test that low at 14.5. All right, next up, Lilly. Eli Lilly. Now, we were talking, or I was talking about Johnson & Johnson earlier, and the fact that I would not like that as a stock to consider in the pharma space. Lilly is one I would consider. And the reason is the exact opposite reason I gave you on Johnson & Johnson. Remember, Johnson & Johnson was trading down near its relative lows. Look at what Eli Lilly is doing on a relative basis. Wildly outperforming its peers, wildly outperforming the S&P 500. And so if pharmas come back into favor, this is the stock I want to own. Now, it's pretty clear to me where the resistance is. We want to get a breakout above that 120 level. If we can close above 120, I think that would be extremely bullish. I could also maybe draw this a little bit of an ascending triangle. Technically, this is point A, B, C. D could still come back down. I mean, we could come all the way back down to 112 and test this area. So it might be a little early to draw this trend line here, but let's just draw it there. I think as long as 112, 111, 112 holds on Eli Lilly, I like the stock. I think this one's going to go higher in time, and it is one of the better performing pharmas. All right. So that was number 7. Let's go into number 8. And that is NSC. Get into the railroads. Norfolk Southern dropping today, hasn't been able to get to those recent highs. On a relative basis, you can see it's just okay. So if I like the railroads, and the railroads, if we get a relative breakout, then this is a stock you certainly could consider. Let's take a look at the chart and the annotations. So from a absolute basis, I want to see Norfolk Southern get through about 174. That's where we have failed since the beginning of the first quarter when we started to sell off on heavy volume. Each failure has been near that 174 area. So I'm not going to get overly bullish until I can clear that price resistance level. As I go further down, like I said, on a relative basis, just kind of going along for the ride here recently, but the stock relative to the S&P 500 is getting closer and closer to a breakout. So if we can get Norfolk Southern to break out relative to the S&P, we already have pretty good relative strength in the group. So I just want to see NSC break out and start showing some leadership relative to its peers. So that would likely occur if we can get up through that 174 area. Technically, there's probably other railroads that I would consider ahead of NSC, but a move through 174 would really begin to look much more bullish for the stock in the balance of 2019. All right, Zynga. Well, first of all, look at the toys. Very, very weak group. So the stock is doing tremendous versus the group, but it's got some overhead resistance that it's getting near. So this is one, because the group is weak and because the stock is getting close to resistance, I would actually be a seller unless I see this breakout or until I see the breakout. I think that 440, 450 area on multiple occasions. And you can see here, very, very heavy volume, but sellers came in at 450. Stock, I'm sure, was very oversold there. I'm sure it's very oversold now. As it gets into the 440, 450 range, it could break out, but it may simply top like we've seen on multiple occasions. So I think the best trade is a sell in the 440, 450 area. Maybe you could rebuy it on a pullback, especially if it's light volume pullback to that rising 20-day moving average. So that would be what I'd look for to the downside. All right, and we're going to wrap up the 10 and 10 with a Canadian stock. Always try to look at a stock for our friends to the north, OSB.to. I probably don't need that relative chart. I don't. This rally off the September, October selling has been pretty weak. Outside of the opening gap there, it's really just been sideways. So I've got some problems here. I think we're going to go back down and probably test this low, just below $32. Not a big fan here. What would change my mind? Getting through the recent resistance and seeing some volume on that move. We already took out a double, triple top, really, at about $38, and we did it with volume and we couldn't hold. So that just tells me that maybe it was just a head fake, and we're probably going to extend that downtrend that we saw previously. So this one's, probably still a little bit up in the air, but I believe that the stronger likelihood is that we're going to go back down below $32. I would avoid it personally. All right, and that is it for the 10 in 10. And so there you have it on your screen. And now we're going to get into the final market update and see what is going on. Well, what is going on is not good. You can see the Dow Jones Industrial Average now down 371 points. The NASDAQ down 131.5. The S&P 500 down 43. And the Russell 2000 down 25. But on a relative basis, you can see the NASDAQ 100 really struggling, down 1.96%. I thought as part of this update, what we could do is take a look at those FANG stocks. So let's start off with Facebook. Facebook only down about 1.5% today, which isn't bad, actually. And one of the big questions I'm going to have is if we do fail at the 20-week EMAs, and I think Facebook is still below its 20-week, but let me pull this up. So if we fail, and we closed just above the 20-week, but now we're right back down. This could be a head fake. So we're going to want to watch this pretty closely. But if we fail to hold the rising 20-day EMA, let me go back and show you that again right here. 143, 144, actually 143. If Facebook were to go back and close below 143, remember that the big picture, the weekly chart, is ugly. So if the daily starts to break down, you can't ignore the fact that this is an area where we could have a serious downturn off of a longer-term weekly chart. And this is the part that scares me. Now, there are a couple of the FANG stocks. I know Amazon was well above its 20-week, and actually it too is coming back down. It's below its 20-week now. So I don't know. This doesn't look good to me. Netflix was one that was probably the best looking, and it is still well above its 20-week moving average, and the volume coming in was good. Netflix looks like the best stock to me in the group. And that doesn't mean we can't pull back and maybe get a 20-week test. But I think relative to the other stocks in the group, if we pull up Apple, you're going to see not even close to its 20-week moving average and rapidly rolling right back over. And then Google, I think, came up and tested its 20-week. Yeah, just actually did get above Friday, but it too is falling right back down below. So we're seeing a lot of selling now beginning to pick back up. The other thing, last thing I'll mention during this update is we want to watch the VIX. I have said on many, many occasions, the volatility index during the last two bear markets never went below 16 to 17. The double bottom that we saw in the VIX was at 16 in November and beginning of December. And when you look at the S&P 500, that coincided with the two tops when the VIX got to 16. Well, last week we had the VIX get down to 17, all the way from 36. This is the area where fear could pick back up again, and we could see the next leg down in the market or another leg down. Personally, what I would like to see is a retest. I don't know if we go all the way back down to where we were, but that would make me feel better about the market if we could go back down and get that retest on the S&P 500. And of course, what that would mean would be falling quite a bit, all the way back down to 2350, currently down 1.7%, but we're 2625. That would be another 10% from here, maybe 11%. So anyway, that is the update. We're going to get into I'm going to get into the final segment today, which is the blog highlights. First thing you can always do is you can just go into the articles. So let's talk about, some of these articles. I found Art's, this is for members only, but I found Art's to chase or not to chase article really solid today. And what he did, he went through, and we've had questions on the show here about high frequency trading and dark pools and so forth. And Art talks a little bit about that and some of the estimates. So for those of you who maybe have some questions, I think that would be something that you might find some answers to some of your questions there. But what Art did and it's similar to what we've done here on Market Watchers Live, is he went back and he showed some of the periods where we've had some really tough times over the past 10 years and what he has looked at to determine whether or not the rallies are sustainable in essence. I mean, he starts to look for bullish patterns to emerge on pullbacks. And I think that's really important. And that's what I was talking about earlier. When we pull back, what kind of a pullback is it? Is it just is it going to be a bearish wedge or a symmetrical kind of a triangle that just simply extends the prior downtrend? Or is it going to be a correction where then we have a surge through it and go back and print some new highs, which would, lead us to think much more bullishly? And anyway, if you haven't seen this article, I think you want to go back and read this one for sure. Those of you that have lots of questions about the history and do you chase? Should you be jumping in after the market goes up 3 or 4 weeks in a row? This is just a walk down memory lane. And I think Art did a really good job with this. So if you want to get back in, take a look, maybe look at the market the way Arthur looks at the market and how he's looking at 2019 down here at the bottom. What now? This is again, a great article to go in and take a look at. Again, this is behind the paywall, so you do need to be a member to read this. But I mean, you'll get Arthur's information. You'll get John Murphy's, Martin Pring's, all of those behind the paywall. And that's a lot of experience and a lot of knowledge. I certainly want to check that out. Okay, the other thing I wanted to mention was that if you go into the articles area again, we had a Chart Watchers out over the weekend. Now, some of you may not be familiar with Chart Watchers, and if you're not, you should be, because this is the best deal on the internet. If you are into investing and you are not a member or a subscriber of the Chart Watchers newsletter, I think you're doing yourself a huge disservice. It's free. I mean, let me repeat that. It's free. You don't have to pay anything. All you have to do is type in your email address. If you go into the articles area and on the right-hand side, you just type in your email address and sign up. If you're on the dashboard and you scroll down to the bottom, join our free twice monthly Chart Watchers newsletter. Put in your email, sign up. The email will get, or the newsletter will get emailed to you. It'll be sent to the email address that you provide us. I don't know a single reason why you would not want to be a subscriber of the Chart Watchers newsletter. So we just had a newsletter come out this weekend. So if we pull it up, you'll see the articles that we wrote. I'm going to go over mine in just a second, but there were 3 stocks on my strong earnings chart list that I think, based on the way they've been trading, I think it's just a matter of time they're going to come out with a great earnings report. I'll be shocked if they don't, based on the way they've been trading and the fact that they're in some strong groups that the market's favoring right now. Julius, if you remember, Julius was on with us last week, and he came in and showed you RRG charts. Well, he has an article in Chart Watchers talking about the FANG stocks and how you can look at them on a relative rotation graph. Great article. Arthur talking about separating contenders from the pretenders. And so we know that when the S&P 500 moves up, we see a lot of stocks moving up. I had some short candidates I still think have weak charts, but they were going up last week because the market was just going up and money was rolling in and it was just buying everything. It's like throwing darts at a dartboard. Whatever you hit sticks. The market was going up. But separating the contenders from the pretenders takes a little bit better analysis. And Arthur went into that. I thought it was a great article as well. John Murphy, what can I say? I have to say that John is one of my biggest influences in the stock market. He is one of those, I mean, he really got my interest in intermarket relationships. He's the one that really drove my interest and encouraged me, inspired me to do a lot of the work I do right now. Anytime you can get your hand on anything that John Murphy does and it's free, why wouldn't you want to do it? But John posted on the stock rebound that we saw in January and the fact that it was continuing. Another good article. Greg, I was just talking about railroads and the fact that railroads have been pretty good performers. Greg, very timely article, talked about railroads back in an uptrend after the fourth quarter correction. So you can get a little bit more analysis there. John Hopkins, earnings season kicking into high gear. I'm actually going to be doing an event with John this afternoon at 4:30. If you are interested, you can come into his article. I think it's in my article, but there is a click here link where you can subscribe. Again, it'll start at 4:30. If you're interested in going, though, I would register and be ready to get into the room by 4 because I do think it's going to be a packed house. And once we reach capacity, you cannot get in. John, I'm sure will send a video recording to anybody who is unable to get in. But if you want to go and you want to be in live, ask questions and that sort of thing, you want to make sure you get in early. But John talked about Signet Jewelers and the fact that their earnings missed. Look at the stock, the way it was performing before earnings came out. I mean, that's a clue. Everybody's selling. Why do they sell? Because they've been out at the company's management, talking to company's management, and they got wind that things are not going very well. So they go back to their, Goldman Sachs analysts go back to the firm, and guess what? They sell their clients Signet Jewelers stock if they have any. That's how the market works. So when you're looking at price action, many times you see what's going to happen in the report that's coming out. So technicals precede fundamentals. For those of you who are fundamentalists, I can tell you I'm a CPA. I'll give you all of the earnings reports, and you give me the charts. You can take a look at all the earnings reports that come out. I don't ever need to see them again. Just give me the charts. I can tell you what the earnings are going to be based on the way the stocks trade. Aaron posted the utilities group lights up a new PMO buy signal. Why is that important? Well, if we're going to move back lower, pretty important to know that a defensive group is starting to sport a buy signal. So this is the kind of information that you're going to get twice a month, and it's free. So I'm going to tell you one more time, or suggest to you, I'm not going to tell you anything, but I'm going to suggest to you that if you are not a current StockCharts Chart Watcher subscriber, go in here, type your email address, and sign up. All right, now as far as the stocks that I had talked about, I'll go ahead and go over those with you. El Pollo Loco Holdings. I don't know if you're familiar with the stock, but it's in that restaurant group, restaurants and bars. Look at the stock breaking out last week. Now, I think it's overbought, and it's something I'd be more interested in on a pullback, and I don't hold into earnings. So if you're going to buy the stock and hold it into earnings, just beware. Stocks can do their own thing, but I do like what's happening. I mean, you got a stock that's breaking out in a market that has so far away from its recent highs that you can't even sniff it yet. And yet you've got Loco making a new breakout in a strong group in that restaurant and bar area. Check out the scooter rank, 97.8. That tells you it's better technically than just about every stock in its market cap arena. So, and look at the volume coming in. So I think you've got some accumulation taking place. So I think Loco certainly looks like a good stock to at least consider. And if you click on this, you can see the live version of the chart. And even though the market's down today, getting hit pretty hard, stock was up to almost 18 earlier before pulling back. It's been a beast to the upside. And I think that is indicative of a strong earnings report that's going to come out. Now, if it's up really high going into earnings, what we might see is a buy on rumor, sell on news. So we've seen that plenty of times. But if they have a great report and the stock gets sold off after that, I think it'll set up great opportunity down the road. Okay, next stock was Alarm.com, another stock making a breakout in a very weak overall market. Volume trends really strong. Let's see, ALRM. Well, we did have the PPO starting to accelerate to the upside, making the breakout, like I said, volume high. Scooter, 97.7. Any of these scooter ranks that are up in the upper 90s tells you that they're basically the best stocks technically in the market. Doesn't mean that it's a great buy point. And I need to stress that because you got the RSI, it's overbought. I'd much rather see the stock pull back and get it, say, on a 20-day test. But ALRM looks pretty good to me. Finally, Crocs. This is in the footwear space. Talked about Skechers earlier, talked about Nike. Well, here's another one. Crocs made the breakout on very, very nice volume earlier in 2019, pulling back, but I think the pullback is an opportunity. The stock, you can see the gap up with its earnings back in November, probably comes out with earnings again in about 3 weeks. So you got a little bit of time, but I suspect based on this move up and a breakout in the market that we've been seeing, I think that bodes really well for Crocs as we go forward. So this is another stock that I think I'd be trying to pay pretty close attention to. All right, so that is it. I just, again, if you're not a subscriber of Chart Watchers, I don't know why you wouldn't be. It's free, great information, a lot of excellent. I mean, I'm privileged to be able to write alongside of all the talent that StockCharts has accumulated over the years. And the information twice a month is outstanding and really unmatched anywhere. All right, so there are the highlights of the Chart Watchers. And then also To Chase or Not to Chase by Arthur Hill. His blog, Arts Charts, another one that you want to certainly watch closely. Okay, let's talk a little bit about the overall market. Let's see, because we are starting to see some selling, I'll give you a quick update on that. Here you can see, yeah, still pretty weak. We are bouncing just a little bit off the lows, but the Dow down almost 400 points now, 382. We haven't seen a day like this. Remember, over the past few weeks when we've gapped down in the morning, we've rallied back. This one looks a little bit different in that we haven't seen that rally. So unless we get a big rally here in the last 2.5 hours, this is really setting up perhaps for some additional weakness coming down the road. And we got a lot of big earnings reports out. And the history of the market, by the way, is that we tend to see the market move up into earnings, and then we tend to see the market sell off after earnings. So this is not unusual in that respect as well. Number of things to keep in mind. I know we went over a lot, and hopefully I didn't bore you too much with 90 minutes straight of talking. But we did get it through a number of different areas, segments, stocks, major indices, and so forth. So I think it's been good. I've enjoyed it anyway. But you'll be back over the next few days with some enlightening commentary from some other folks, which I think is good, because you want that well-rounded perspective on the market. I know I tend to, have my tunnel vision on the way I look at the market. Erin does her thing. So I think it'll be great if you get Arthur, Mary Ellen, and Greg Schnell coming in Thursday, Friday, and Monday of this week to give you their take on what's going on in the market. And then you can kind of follow the consensus or what you think of the market as we move forward. But here is the S&P 500. You can see down 43 points today, 1.64%. And again, as I mentioned earlier in the show, if you came in late, we are failing at the 20-week moving average. And this right here is important technically in the market as we go forward. This is not unusual. We have seen this plenty of times in the past. And so we need to pay attention when we get up to a key level and we start to reverse. So if the bulls could somehow, again, pull that rabbit out of their hat, jump back up, get through that 20-week moving average, we could be off to the races. But the flip side of that is that we could be heading back down to test, maybe putting in a double bottom, possibly going lower. I don't think so. I think that selling in the high VIX reading probably is marking a bottom. But there's your upcoming schedule. Jeffrey Sott tomorrow. Be interesting to get his take. I know he's been much more bullish. And then we've got the rest, as I spoke about earlier. Want to thank everybody for being with me today. Please remember to complete the survey. How'd I do for 90 minutes? I'd love to hear from you. As a quick reminder, Market Watchers live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. See you back here tomorrow. Happy trading.